Today was, simply put, an amazing day of never-befores and not-sinces. Never before has the Dow Jones Industrial Average dropped as many points as it did today, 1,190. Never before have the S&P 500 and NASDAQ shed so many points in a single day either. All three major averages fell more than 4%. Never before has the S&P 500 dropped so far, so fast, from an all-time high, diving 12% into so-called correction territory after hitting a record high just a few days ago on Feb 19. And never before has the benchmark 10-year U.S. note traded as low as it did today, below 1.25%. Every major sector, from technology to utilities, have been hit and now sit below key technical levels. This sell-off is not just an American event, by no means. Stock markets all over the world have dropped close to 10% or more in a week, and U.S. blue chips, as we mentioned, haven't had a week this bad since 2008, and there's still a day left. Investors, of course, dealing with this major stock market drop, and Bob Pisani has been at the center of it all day long, the New York Stock Exchange, and he's still there live. Hi, Bob.
Tyler, this is a takedown of the entire global stock market. This is not about technology versus industrial sectors or China versus U.S. exposure or about value versus growth. The markets are down across the board, regardless of location, regardless of size, regardless of your investing style. We saw this again today. You can just look at the Dow Industrials. Consumer stocks like Nike and McDonald's and Procter & Gamble, they were all down, look, 3 to 5%. But so were industrial names. I'm talking about United Technologies, for example, or Boeing. They're down essentially the same amount, along with bank stocks. They, too, were all down 4, 5%. Goldman, J.P. Morgan as examples. Now, some tech names like Apple and Microsoft, they were down a little bit more today, but that's only because they held up better going into trading today during the prior 3 days. So they're down 12 or 13% this week, just like everybody else. Elsewhere, as we've had these big drops, we are seeing a significant expansion of new lows, particularly in the transportation sector, where the airlines and the logistics companies have been devastated. How crazy is all this? I'll give you an example. Southwest Airlines hit a 52-week high less than 2 weeks ago. Today, it hit a 52-week low. Wait a minute, a new high to a new low? Down 20% in less than 2 weeks? That is what you call volatility. As for the global takedown, this is what I'm talking about. Everything is 10 to 12% off of the highs. It really doesn't matter where you are, in Hong Kong, in Europe with the stock 600, in the emerging market sector, in Shanghai, in Japan, the S&P 500, same thing. Everything is down just about the same amount. The markets are telegraphing. They anticipate this is indeed a global phenomenon. Tyler, back to you.
Pisani, thank you very much. Let's bring in CNBC contributor and market historian Ron Insana. Welcome. Good to have you with us.
Thank you, sir.
Give us a little context here. This is a sharp and very fast correction. As we mentioned earlier, never before has the S&P 500 gone from an all-time high to a correction, more than a 10% decline ever before. But we've had 26 corrections since World War II.
Yeah, exactly. And the thing about it now, in years past, we probably would have called this experience a mini crash. You are down 12, 13% in 7 days, in 7 sessions. That is unusual. It's not unprecedented. I mean, again, we've seen these things happen before. But as you pointed out earlier on, this is the fastest move, 10% or better, off an all-time high that we've ever seen. The last time something like this happened, I believe, as Carl Quintanilla pointed out, was December of 1928. So it is rare. 4% daily moves are rare. And so, you know, it is the type of thing that can unnerve investors. It is still, for the moment, a correction. And corrections are, by definition, short, sharp, and scary. But the updraft that we saw in global markets last year was equally powerful. You saw markets go up 20% on average around the globe, here at home even more. And so now they're moving in tandem to the downside, not only because of the coronavirus fear, but because beyond the human toll, there are concerns that there will be a serious economic toll.
We just had a graphic up there showing 4-day declines, I believe it was, historically, and where this one ranks, and it is up there or down there.
Exactly.
If you will, the point here that I'm thinking of is this: whether it was 2008 when something happened that had never happened before, and that is American home prices lost value, and we had a real seizure in the securitized markets. Whether it was 2018, where we had a large fall off in the fall of that year because interest rates went down, it always seems that it is the unanticipated thing that trips you up. And here, something that was not on the radar screen 8 weeks ago has brought the market down.
Oh, absolutely. And now remember that 2008 was a systemic financial crisis that was global in nature.
Yes.
And it took ultimately the fall of Lehman Brothers and several other financial firms to bring the Federal Reserve into the market, cut interest rates to zero, launch unconventional policies that stemmed the tide. Now it's expected the Fed may come in and lower rates. The question, though, is this type of unexpected event, which is health-related, that has disrupted the production process of all manner of goods, from autos to cell phones to even pharmaceuticals, whether or not a rate cut or any intervention like that would have the same palliative effect on the market. So that's a key question. But this is, unusual. And as a consequence of this, you've seen Goldman Sachs, for instance,
say there's going to be zero growth in the United States.
Yeah. And now we're looking at possible zero GDP growth in China, 0 to 1% in a country that's supposed to grow 6% per quarter, every year right now. And that makes everybody else sharpen their pencils, take a look at global growth, domestic growth, and say, okay, if we're looking at 2.5%, maybe it's 1 or 1.5.
So a week ago, I guess one could say, or 10 days ago, one could say we have collectively, as a market, underestimated the potential of this coronavirus to do damage. Are we still underestimating it, or are we now close to estimating it as best we can?
I don't know. And I think, and someone said earlier on CNBC, I think it was Carly Fiorina earlier today, a former presidential candidate, former CEO of Hewlett-Packard, said, we don't know what we don't know. And I think when you look at this right now, as it fans out across the United States, you've got 8,400 people being tracked in California. You've got school closings in Japan. I think the big question, as much as this looks like a very panicky market, is what happens to the financial markets if there's a school closure in the United States and some municipality decides they're going to err on the side of caution? That means people start staying home. It means they start, as we discussed several weeks ago, they start cocooning, as we described it in the post-9/11 environment. People simply didn't leave their houses either for work or for play or for shopping, only for basic necessities. So I think that possibility has to be considered. Obviously, from a technical perspective, this market has gone from vastly overbought to vastly oversold in just a matter of days. So it's always possible that it could bounce. Sometimes bottoms are points in time. Other times they are processes. I suspect this time this is a process-oriented bottom, not that kind of V-shaped takeoff that you get even if the Fed were to do something like an intermediate rate cut.
Thanks for joining us, Ron.
Thanks for having me.
Always good to see you.